October 3rd, 2023. You can see the past 2 days had a bear channel, and generally a bear channel is going to become a bull flag. When you get an overshoot of a bear channel line like we did today, there's a 70% chance that you're going to get a reversal up within 5 bars. But that is on the highest time frame that you can see the bear channel. So if you go into the hourly chart, which is the chart that it's available or it's visible on the highest time frame I looked earlier, you can see we have this, and then it's a channel. And there's a 75% chance that you're going to get an attempt at a reversal up within 5 bars. You can see that's basically what we're getting down here. Bulls probably tomorrow, I would think, are going to try to rally. I've been thinking bulls are going to try and rally for the past couple of days. I think we're pretty oversold in general on the daily chart, and we're probably, I'm just going to look at that first, go over that first. I just think we're pretty oversold in general here. We have a couple pushes down, one, pullback, two, pullback, three. We probably have to get back to this low. The bulls who bought below here are probably going to make money because this is more likely, a leg in a big trading range that started over here. So I think the bulls who buy below here are going to make money. So I think we're getting back to that low. I still think the bulls who bought below here are probably going to make money. So I still think we're going to get back to this low. But, that's not obviously as certain. But I'm pretty sure we're going to get here. And you can see we got a tail on the bar at the end of the day, indicating uncertainty. And at the very least, we should get back to this low tomorrow. So when you get a big bear trend day, you have to keep in mind there's a 75% chance of 2 hours of sideways to up trading starting by the end of the second hour. So tomorrow on the open, there's a 75% chance that we're going to get at least 2 hours of sideways to up trading that starts at the end of the second hour. On bar one today, we got a bull bar closing near its high. It didn't close all that strong. It was basically, it was a big gap down, and this was a pretty tight channel. So I was expecting a stronger second leg than we got. I don't know if we even reached the 50%, for bulls who bought up here. Maybe if you bought the close. So bulls who bought the close of this bar, it was a reasonable buy the close bar since we were in a tight bull channel, and it was a bull, bull close. So some bulls buy that close, and they're really disappointed in the gap, and so they'll buy more above bar one, and they'll exit at break even. And you can see that's exactly where we got to on bar five, was the break even price of these traders. Bar two, bad follow through for the bulls. Not surprising with the big tail on bar one. I was hoping we were going to drift a little more sideways and get some sort of double bottom, but we ended up rallying pretty quickly. You can see on bar three, we got a bull bar, but a big tail on the top, unable to close near its high. Bar four, follow through for the bulls, but again, not quite able to close near its high. And with the tail on this bar, the tail on this bar, and the bear bar, it makes this seem like it could just be a second leg trap. So I would be really careful buying up here. I was personally looking to buy, but I was looking to buy lower. I wanted the market to pull back and then buy, somewhere in here and hope that we get a swing up, maybe back up to this close. And then we got another follow through bar on bar five, but again, big tail on the top. When you're getting all these tails, and to me, this confirms that I would rather buy lower. I don't want to buy up here because there's way too much risk that we're going to pull back. Every once in a while, you'll just go, but not enough of the time to make that trade worth taking. Bar six is an inside bar. I wouldn't sell below six. Some traders might, but I think it's really low probability. The argument for selling below it is that 1 and 3 to 5 is a two-legged correction from this spike down. So they're hoping they're going to sell, maybe get a measured move down like here, and maybe they have a 30% chance of that happening. This is super rare on 7 to just get that after that. But occasionally it does happen. Bar 7, there's usually a report at like 10 o'clock. I don't really look. I just know that I'm aware on bar 7 that sometimes there's a report. So there's going to be big moves up and down sometimes on bar 7. But you don't really need to know that. What you need to know is when you get a big, strong close like this on bar 7, that's such a huge bar, you're practically guaranteed a second leg. It's probably 90% chance you're going to get a second leg down. And when you get this strong close, what do you need to immediately be thinking about? You have to be thinking about the traders who bought below 1 during 7. Are the traders who buy below 1 going to be able to buy more lower and make money, right? So if you buy below here, you're going to be able to scale in and make money. And so a lot of traders will sell the close of 7. You should sell the close of 7. It's a high probability trade. You probably have a 70% chance, maybe 65, 70% chance of getting a 1-to-1. And the reality is if you take a loss on this trade, you're almost never going to lose the full thing. So really strong trade on the close of 7. And I think that you have to be paying a lot of attention to the one low, because if bulls who buy here and buy more lower are not able to make money, you're going to have a lot of trap bulls, and that's going to drive the market down. And you can see that's exactly what we got. We got a spike, and then we got the channel, and we ended up getting a correction. Generally, corrections are about half the amount of bars that a trend is. It's a rough number, but if you started on 6, and you could say the correction started, maybe 20 or probably 30, I would say. So that's 25 bars. And this was 15 bars. So it's not always exact, but I think it's good, good frame of reference when you get a strong move and you start to get a correction and you're looking for a with trend move. You generally want it to go about half the amount of bars that the trend was. Followed through on 8 for the bears. So now if you bought below here, you see 7, you see 8, and you're starting to think that the bulls who buy below here are in trouble. Even the bulls who bought below here might be in trouble, below yesterday's low. And you get a big bar on 9, and 9 is really interesting because it trades above 8, and it makes this a possible second leg trap. But you have 3 strong bear closes, and what you notice is that once it got bought up to even close to the low of 1, a lot of the bulls who were long just flattened at the market and just took their small loss and just accepted the loss basically, and that caused a lot of selling on 9. But other bulls would hold and hope that we were going to get up there, and we never did. And so they're going to start exiting below 9, and that's what's going to start driving the market down here. So bears, you can sell the close 7, you can sell the close 8, you can sell the close 9, you can sell the close 10. These are all reasonable trades. There's a big tail here for sure. There's a big tail here, but the reality is it's clearly always in short. When the market is a clear always in direction, you should just get in the market. It doesn't really matter if there's a tail or two. You just, when it's clear like this, you need to just get in. Versus this is not as clear. You have a good bar on 4, and it's probably always in long, but you have to keep in mind that one good bear bar is going to flip that. If you have a good bar like 5, and then let's say you get pretend that 45 or 44 was on bar 5, suddenly bulls are not confident the market is always in long. So if you're 1 bar away mentally, you think the market is 1 bar away from the always in flipping, you're probably in a trading range. Versus look at down here. If you're short here and bulls get a good bull bar closing near its high, is it always in long of that bar? No, this is way too strong. Bears are going to get a second leg. So that's why it's important to keep that in mind when you're looking for something like a sell down here. You got to keep in mind the fact that, even if there's a bull bar after, it's probably not always in long. So it's okay to just hold short. And that's exactly what happens. You get follow through on 11, 12, bull bar on 13, but no one's buying above. You can see there are immediately sellers above. Traders took that as a great price to sell more contracts. And that's why we get a big outside down bar on 14. Probably buyers below 13, but okay to stay short and just look to exit above a second reversal up. That's, what's critical to get good at is just learning to hold in situations like this. Follow through on 16, but bad follow through for those bears on 17. Again, you can see we had this open gap here, and we had a small second open gap. The breakout point below 9. So if traders bought below 9, you can see they were never let out during 11. So we have a few open gaps here. Bad thought. So 17, obviously, it's maybe a wedge. 1, pullback, 2, pullback, 3, but I don't think it's a very good buy above that because it's a bear bar. So that's why there are more sellers. 19 breaks to a new low. What's important to realize, so one strategy for when you're trading in a trend, try to find a better example. So let's say you sold below 44 and you start to get follow through. Once you get a pullback on 47, and then on 49 you get a close below the low of 47, so your stop can go up here. Now you can always you can just trail stops below breakout points. This is a better example. You get a bull bar, and then you get follow through and a pullback, and then when you get follow through closing above the breakout point, your stop can now go here, and then you get more follow through, so now your stop can be moved to the next pullback. And so you can see we got a pullback here, and then it looks like 19 might close below the breakout point, so it would be reasonable to put your stop here. But you got to keep in mind, you got to look closely. What's the low of this bar? 42.6425. What's the close of this bar? 42.6325. Sorry, this low, 42.64 close. Okay, yeah, I was losing my mind there for a second. So 42.6425 is the low of this bar, and the close of this bar is 42.6425. So that means that if you shouldn't move your stop here yet because you haven't gotten a close at the new extreme. And so a lot of traders who did move their stops there, they got stopped out before the market went down lower. And that's why. Something else important to notice is once you get 21, some traders might exit above 21, thinking it's 1, 2, 3, parabolic wedge down to 21. Other traders, I think always in short bears get out above 26. It's probably a parabolic wedge. And if you think about 26, I'm going to skip ahead for a second. If you think about 26, what's left to gain in this bear trend? What are you hoping is going to happen? You already had a big spike and you're in the channel phase and you're at the bottom of the channel. So we're probably at least going to pull back. We're probably going to get to the moving average and you're really deep in this channel. So it might be, this might be a very climactic bar and you're probably going to get back to the moving average and form some kind of trading range. Will it eventually probably get back to here? I think so, but you have to what is really, how much do you really stand to gain by staying short above 26 when you can exit and look to sell again lower or something, or, sell again higher, more likely. But a lot of traders would exit above 21. And you can see we got exactly a measure move above 21, which is another red flag for the bears. It means that bulls who bought above 21 basically made exactly a 1-to-1 and they were able to make a reasonable scalp, which means it's making it less likely that this bear trend is going to continue down. So you get outside. So like I said, follow through 22 and then you get 23. So you also have to keep in mind that's around the 15 low. So bulls who bought below 15, they bought more lower, they made money. Bulls couldn't make money here. Bulls couldn't make money here. Now bulls can make money. What does that tell you about your bear trend? It's not as strong as you want it to be. So once bulls start making money, you have to be skeptical. And that's another reason why people will exit above this bar 26. But probably sellers above 24, it's a bad double bottom. Big bear bar closing near its low, 25, and it traded above 24. So it could be, another 2 legs down. Probably okay to exit above 26, like I was saying. And you get bad follow through 27. Bear bar closing near its low on 28. But, I don't want to sell below that. It's better to maybe sell the extreme. If you're always in bear, you have to find a way to get short again if it's going to keep going down. So probably better to sell the breakout below 26 if you get it. And you can see we never did. 30, follow through for the bears, but big tail on the top of the bar. So there was clearly some buying pressure. Big bull bar, that was 29. Big bull bar on 30. And 31 is just a give up bar for the bears. So bears who are short for any reason, let's say they never exited above 21, they stayed short on 26, and then they see 30 and it's a double bottom. And at this point, it's pretty undeniable that we're probably going to moving average. So the remainder of the bears who are still short are just going to exit above 30, and that's what causes 31. And when you see 30 and 31, it might look like a tempting buy, but in reality this is just bears getting out of shorts. So once there are no more bears left to get out of shorts, the market's probably not going to go that much higher. And that's the reason why there's bad follow through on 32. Additionally, this is, a bear trend and we're now at the moving average and we haven't been there. So you're probably going to get some sort of 20 gap bar sell and bears are going to look for a swing short. So not a lot of bulls willing to buy the close of 31. If you are taking that buy, you need to have a pretty wide stop somewhere down here and be willing to scale in lower. Even if it gets down here, you still need to be willing to scale in. 33, that like we said, probably buyers below 32 because 30 and 31 is very strong for the bulls. So probably buyers below 32. You get 33, it's a high 1. Follow through on 34, but bears know that if they sold above 32, they're probably not going to get trapped the way these bulls did. Why? Because this is a strong bear trend. And so even though we're probably just in a trading range, they see this as selling high in a trading range. So they know if they sell above 34, or if they sell above 32 during 34, they're probably not going to get trapped like how these bulls got trapped here and here. And so that's one of the reasons why you get bad follow through on 34. Additionally, bulls who bought above here are just scalping out. They got quick 1-to-1 of their true risk. I don't think they got 2-to-1, but they got a quick 1-to-1 of their true risk and they just exited. Just one second. Interesting. 2-to-1 of the true risk. So if you bought above 33, you never know what you have to risk until, the market has already started going in your direction. But once it's gone far enough in your direction, everyone can agree that the stop you had to have was right here, 1 tick below 35. And so once the market's forming 36, you can see the traders, this is their actual risk. And then you get a measured move 2 times that, and that's where traders exit here. And it's essentially 1 push up to 3, so it's a wedge 2. The remainder of bulls, anyone who's still long, probably exits below 37, in my opinion. It's a tight bull channel. But the reality is you're probably going to get well, two realities. One, you're going to get a second leg up, but this is also, probably going to be more sideways here for at least a little while. Bad follow through on 38, probably sellers above, probably buyers below. And then you get a big outside down bar on 39, which would have been a reasonable swing had it triggered. But this was a tight channel, so bulls bought the close of 39, hoping it wasn't going to trigger and hoping they could get another leg up. You have to be looking for two things at this point. You always have to be evaluating both sides. And so at this point, I would be thinking if we get a breakout to the upside and a strong bull close, it's possible that this is a trading range day and we're going to get a measure move up of the bear flag. So this is the bear flag. And we might get a measure move up to here. And if we do get up to here, it's definitely a trading range day, and gaps close on trading range days. So it's not unrealistic to think we're going to close the gap between the 1 high and the 9 low if we start to rally. And so, pretty much any time if you get a strong bull close, bull outside bar on 42, or a strong bull bar closing near its high on 43, I would have probably bought, hoping that we were going to get somewhere up here and just see what happens. I got a little ahead of myself. So 41, it's a double top, maybe a reasonable swing short, but the reality is that you're on, the moving average. So I don't think I want to sell directly on a flat moving average in what's probably a developing tight trading range. If you're going to take this short, you have to get out basically as this starts to turn up somewhere around break even, or you need to sell more above this bar, betting the breakout above the bear flag is going to fail. And you're going to be able to get out at break even probably you're going to be able to get a break even, somewhere in here during 44, or you could sell here, sell more higher, get out of your first entry at break even and a profit on your second entry. And that's what a lot of bears do. You can see that 42 was unable to close near its high. Bulls were disappointed. And 43, again, bulls wanted to rally, but they're failing. They're not getting strong bull closes when they need to. And so that's why we start to fail here and you get a big bear close on 44. Any bulls who are long, trying to front run this are really disappointed in 44. And so always in traders are going to exit below 44. And that's why 44 is a reasonable swing short, because the other side has to exit below 44. Follow through on 45 and 46. We are in a tight trading range, so you might get some sort of pullback. But I think it's okay to be short. And, if you think, so if it's down here and you're thinking, well, I really wish I had sold below 44, that was a good swing short. It's okay to just sell the market. If you had sold this and that if, let's say it's down here and that if you had sold below 44, you'd still be short and your stop would be here. It's okay to just sell the market and put your stop right here. 48, potential second leg, follow through on 49, 50. It's potentially 2 legs down, but this is stronger than the bulls wanted, and this pullback's getting pretty deep. And then you get 51 and 52. 51, probably buyers below, and you get big surprise on 52. So you see we have a little open gap right here, and 53 is unable to close it. And that's what we were doing up here. We were closing this gap with this low. 54, 55, we're down to a new low again. I think if you're looking for a wedge somewhere in here, it's probably too steep to be looking to buy. I would say after 49 closes strong, I would rather just look to short. And if you do get a clear always in flip to the bull side, then you can just exit above that bar. So sometimes on bar 49, you'll get a big bull bar closing near its high. And always in will flip to long, but it's always in short on the close of 48. So I think it's reasonable to sell the close of 48 for a swing, hoping we're going to get basically this to happen. And if you get another bull bar and it becomes always in long, you can just exit above it and reverse to long. So I think that kind of trade is really hard to take, but the management is not that difficult, because if you get a reversal up, you're getting out, you're going to buy. And if it continues down, great, you're going to make money. So I was down here, follow through for the bears, 54, 55. It's 3 pushes down essentially to 58, and it's a micro double bottom with the 56 low and the 58 low. It's essentially a lower low double bottom, and they could try some sort of major trend reversal since you had this trend line and it broke. But, this is pretty tight and probably going to get a second leg. So I think bears good to exit above 58, but probably not worth buying. Follow through 59, not all that great. You can see tails. 60, not all that great. And then when you get 61, I think any bears who are not exiting above 58 are getting out above 61, and you get follow through 62. 63, 64, like I said, we're testing that 51 low, and you get some sort of double bottom. I was thinking we might get a buy the close finish. I was looking to buy in here, but once, I was hoping that 70 was going to close on its high and be like a small outside bar, and I could buy that and hope we, take a chance we're going to rally, but it wasn't. And then you get 71, but it's really not all that good. And then once you get 72 closing near its low, I would rather just, this is a tight trading range, so I'd rather be done. So I just kind of let this go. Um, So stop orders on the day. I thought selling below 7 was good. Sell at the close of any of these bars, and it's always in short, so you can just sell at the close of any bear bar closing below its midpoint. Probably get out above 26, definitely above 30, and always in bulls can maybe buy, but it's difficult to do. They definitely exit any bulls who bought exit below 44, and bears will sell, and then exit above 58. Bulls can maybe buy above 58. It's kind of an aggressive swing, though, with how tight this is. It should get a second leg. And if you bought above 74, a lot of those traders just got quick, 5-6 points and just took it. And that's one of the reasons why we got 75. Some tail on the top. Yeah, that's pretty much the day.